Good afternoon, everyone, and welcome to this Art of Trade station titled Filter Out Market Noise Using Price-Based Charting. So, yes, we're going to take a look at charting, some of the functionality that is on TradeStation, and the technicalities and the intricacies of building charts based on price movement. I think it's a fascinating topic, and we're going to take a look at all the different chart types that are available in TradeStation for you to be able to do so. So I want to appreciate the time that you guys are giving us to present topics on TradeStation. It's always fun for me to present on TradeStation technology. So we're going to take the next 45 minutes to do so. Let's go ahead and talk about or go through some of the disclosures. I think that's important to do before we even start on the content. Keep in mind that every symbol and idea that I talk about in this presentation is for educational purposes only. It is not a recommendation of TradeStation. Active trading is not suitable for everyone. It should only be done with risk capital, especially if you're trading options and futures that are leveraged products and are risky. And if you look at past historical performance, of course, this is no guarantee of future results. For additional information on these disclosures, please visit tradestation.com and you're going to find all the disclosure information there. Okay, going back to what I was talking about earlier, we do have an educational platform. The website is youcantrade.com, and we do getting started classes there every single week. The Getting Started with TradeStation is a channel hosted by TradeStation on youcantrade.com, and every Wednesday we meet there to highlight a certain platform of TradeStation. We have the TradeStation desktop, we have web trading, and we have mobile. So it's always good to know exactly what platforms we have access to so that you have access to your TradeStation account and to trading your account wherever you are. So that's every Wednesday inside of the Getting Started. No fees. This is all free content. We do have a premium channel. We call it the TradeStation Masterclass. When you're ready to take your education to the next level, this is the place to be. We have premium courses. We meet there every single day live, and we talk about technical analysis. We talk about strategy development. We also program custom easy language. We have exclusive guest speakers. So if you haven't had a chance to check out the content inside of the TradeStation Masterclass, please do so. The website is youcantrade.com. So when I was referring to the Q&A that we do on a weekly basis, it's inside of these channels. We have one for the Getting Started. So that's one that you can join and ask any questions about the TradeStation platform. And then we do a couple of sessions for the Masterclass for Q&A. So make sure that you bookmark the page and check it out when you get a chance. Let's go ahead and get started on the content. I did say that I was going to talk about price-based charting. The whole reason why a trader would want to look at price-based charts is because it removes any noise, any price movement that is not significant and that would be distracting in your analysis of the chart is completely removed because these charts are based on a user-defined price movement, a significant price movement. So if it doesn't meet what we consider to be significant price movement, the chart will not do anything. So that's the basic concept of price-based charting. Before I even talk about the ones that are available in TradeStation, let's go ahead and set up this topic and why it would be interesting to look at price-based charts. I'm going to jump over to TradeStation for a moment and show you a couple things. We're going to talk about the ones that are mostly the ones that are most common, the ones that everyone use. In fact, when you open up a chart analysis in TradeStation, TradeStation even makes the default a time-based chart. I've changed mine, but I do know that the first time that you open up a chart in TradeStation, it's going to be a 5 minutes. Let me change this to a 5-minute chart. And every single candlestick here is the equal amount of time, 5 minutes, regardless of how much volume there is, regardless of where the price went. It can be a very volatile candle. Every candle is exactly the same amount of time. Which is not fair for some symbols that may be experiencing a lot of volatility. There's other forms of capturing this type of behavior other than time. Time is very equally, all the bars in a time-based chart are equally determined by the time period. And as I said at the beginning, it doesn't really matter how many shares are traded. It doesn't really matter where the price went. They're all the same amount of time. We also have, if you go here to time frame and you go to customize, in addition to having, the minute, daily, weekly, and monthly, and even the second, starting from second, minute, daily, weekly, and monthly, these 5 ones that I'm highlighting, those are all time-based. So every candlestick and every bar represents the same amount of time. Above that, you have 2 that are volume-based. So we're not really taking into consideration time. We're not really taking into consideration price. We're just looking at volume. We have the ones that are based on tick. So if I make this a 1,000 tick bar, let me make it here and load it up here. Sometimes when you go into the tick level, the chart analysis windows sometimes take a little bit longer to load because you're loading every single tick. So this is a 1,000 tick bar of Spider. What does that mean? That every candle is built based off 1,000 trades. It's a 1,000 tick bar. So if trading for Spider slows down, the bar is going to take longer to build because it's going to wait for 1,000 trades to happen. Now, if trading for Spider picks up and volume, starts increasing, that bar is going to build up much faster and it's going to go on to the next bar. So in periods of high volume, you get more candles. And in periods where volume slows down, you get less candles. So the chart is sensitive to the number of trades that are happening on the market. Very interesting, right? Now we're not looking at time. Every bar does not represent the same amount of time. We're looking at how active the market is. Now, the price could be flatline. The price could be like for example, right here, Spiders is trading at 464. All the trades could happen at 464, so it creates more like a flat line. But as long as there's high volume, you're going to get these candles created because it's just counting the number of ticks. If I go back here to sessions or time frame, and go to customize, the other one is volume. Volume does not count the number of trades. It actually counts the number of shares traded. And if you're into futures, it'll count the number of contracts traded. So if I go here to volume and I say, well, build every bar based on 1 million shares traded. I think I need an extra 0 to make it 1 million. All right, let me click OK. All right, that's going to take a little moment. So, okay, it just came back. Notice that it says right here at the very top left, it says SPY 1 million, meaning that every candle that you see here is built based off 1 million shares traded. So again, the same behavior as the tick one. When trading slows down, you're not going to get as many candles. But when volume picks up and a lot of shares are being traded, you're going to get far more candles. But again, the price could be flatline. It's not going anywhere. This is all based on volume. So if shares are being traded at exactly the same price, yes, this chart is going to be very active, but the price may not be going anywhere. So in addition to these types of charts that we've already covered, the time-based and the volume-based, we have the price-based. Because the price-based are really important because those are based on price movement. They ignore what we just talked about. They ignore time and they ignore the amount of trading activity that there is. If Spider is very actively trading and there's millions of shares being traded, but let's say the price is not going anywhere, if you're looking at a price-based chart, that chart is going to be static. It's not going to move because what it's looking for is for the price to move. Now, how interesting it is for a trader to be able to modify the way that they analyze the charts by looking at all these different behaviors. I'm not favoring one on top of the other. They all have their pros and cons. So it's really important that when we use a type of chart, that we know exactly why we're using it And do not discount the other two because they may be relevant and they may be important in your everyday trading. So let's go ahead and take a look at the price-based charts that are part of the TradeStation platform. Let me come over here to my PowerPoint. The first one we're going to talk about is point and figure charting. Point and figure charts. Let's go through the PowerPoint. And, point and figure charts filter out time and insignificant price changes, leaving a chart that contains only relevant price movements. It's important that we take a look at these price-based charts because, as we said at the beginning, all of them are going to filter out noise, which is really cool because noise starts getting distracting. If you have some noise going up or some noise going down on the chart itself, it's going to distract you from the overall movement of the chart. On a point and figure, rising prices are displayed as columns of X's and falling prices are displayed as columns of O's. We're going to take a look at point and figure in a moment. The box size reflects the minimum increase or decrease in price needed to add an X or an O to a column of X's or O's, respectively. And the reversal amount refers to the change in price, either up or down, needed to create a new column and reverse from a column of O's to a column of X's and vice versa. Now, I read this pretty fast because I want to go back to a chart and show you in a practical sense what this is trying to say. Because, when you read this, it's like, what are you trying to say? I really don't follow. I don't understand. So let's go ahead and take a look at the O's and the X's of a point and figure chart, which is one of the oldest forms of price-based charting that there exists. And we need to understand how it behaves. So let's go back here to my TradeStation platform because it is important that we understand the box size and the reversal concepts of a point and figure. I'm going to turn this chart into a 5-minute again. 5-minute chart of Spider. I'm going to resize it because I want to have, Spider on one side and Spider on the other side set on a price-based chart so you can see the difference. It's always wise to compare these charts side by side so you can see the effect that a price-based chart may have on the overall market. So I'm going to go here to apps and open up a second chart. And this chart that's here on the right-hand side, that's the one that I'm going to build as a point and figure. So I'm going to go here to time frame on that one, go to customize, and I'm going to select point and figure. When you build a point and figure chart, the first thing that the point and figure is going to ask you is this box right here. It's called the box size. And a lot of people get stuck in the box size entry because they're not really sure what to put in there. What is the box size? What is it that you consider to be a significant price movement? And that's the answer, whatever you consider to be a significant price movement for, in this case, Spider, that is what you're going to put in right there in the box size. Now, a significant price movement, of course, is relative to the time frame that you're looking at. For example, if I'm looking at a 5-minute chart, maybe a dollar movement is significant, but it's insignificant if I were looking at, for example, at a weekly chart. On a weekly chart, Spider is going to move more points than, or significantly more points than just one. So on a 5-minute interval, a 1 minute or a $1 movement may be significant, whereas on a weekly chart, maybe a 20-point movement would be significant because of the time span. So how do you determine the movement of a particular security like the one you're looking at? I'm looking at Spider at the moment. A lot of times when you're building point and figure charts, and we have to take a look at the price movement and the volatility of that movement. And it's very usual to see traders take a look at the average true range in order to determine significant price movements, because average true range does precisely that. It measures the distance from the low to the high, and it tells you in average how far these securities are moving or how much these securities are moving. So let's go ahead and put it right here inside of my left side chart. I'm going to go to studies, add study. And let's go here to average true range. And I'm just going to use the default settings, which is the last 14 bars. Take a look at the average true range right here at the bottom. I'm getting a reading of 0.22. What does that mean for Spider on a 5-minute time frame? It just means that on a 5-minute interval, Spider moves about 22 cents average if you take into account the last 14 bars. If I were to change this to a weekly, now take a look at the difference. Now take a look at the ATR, that's 10.32, that's $10.32. That's how much Spider moves on a weekly interval. So when we look at the box size on a point and figure, we have to think about what is the time frame that we want to look at. The time frame of a chart analysis is directly associated with your own trading style. How frequently you want your trading to be. If you're looking at a 5-minute chart, then you're going to be trading intraday. There's no reason why you would look at a 5-minute chart if you are a position trader, and you would have to look at more longer term charts. But the fact that we have the availability of this study, which is the average true range, it's a measurement of how much the prices are moving up or down based on the interval that we want to take a look at. So let me go back here to a 5-minute chart. Let's say that that's the time frame that we want to look at. We know that in average, Spider is moving about 21 cents. I see the average right there at the bottom. And I'm going to use that as a measure to plug in into my point and figure. Let's go over here to the right-hand side, time frame, customize, point and figure. And right here in the box size, I'm going to use a variation of average to range. It doesn't have to be exactly average to range, but I'm going to set it to 0.25. I'm going to do a quarter of a point. I usually round these numbers so that I can have significant values, but it's going to be somewhere close to what the average true range reading is. All right, so the reversal amount is also something that you have to think about, and it is defaulted to a number 3. And what that means is that whenever the point and figure establishes a trend, meaning that the price is going in one direction, if it's going up, it'll be a column of X's, right? A green column of X's. And if it's going down, it's going to be a column of O's. Once it establishes that direction in the prices, it's going to have to hit the reversal amount in order to change directions. Let me explain that a little bit more. Let's say that you are in an up column, a column of X's in a green column, and the price goes up by 25 cents. It'll add one more X. It goes another 25 cents up. It adds another X. And it's going to continue to do that as long as it goes up 25 cents, which is your box size. But if it starts coming down, it's not only going to look at the 25 cents you specified there, it's going to look at the reversal amount, which is a factor of your box size, 3 times your box size. So if your box size is 25 cents, your reversal is going to be 75 cents. So whenever it's turning in the opposite direction, it's going to look for 3 times your box size in order to switch to a different column. And that's what the PowerPoint said. If I switch over here to the PowerPoint, that's what this information is explaining to you. That you, first of all, have to determine what you think is going to be a significant amount of price movement, whatever that is. I use average true range all the time to see what are the significant price movements, and I plug that into my point and figure in the time frame that I want to analyze. Let's go back here to the chart and show you a few things. I'm going to leave it on a quarter of a point times 3, and I'm going to click OK. All right, so here's my point and figure. Let me open this up a little bit, and I want to correlate, the beginning of the day to what I see here on the point and figure. The beginning of the day, let me draw a vertical line here on the left-hand side. The beginning of the day is right here. So anything beyond this vertical line that I just drew, that is what's happening today. Here on the point and figure, it's kind of tough because we did say at the very beginning that these are not time-based. So they're not looking at, when the day's over. They're not looking at the beginning of the session. It's whatever the price is doing through the history of this particular market. But I do have some dates here. For example, if I click and hold the background, I can see that this column is November 10th, which is yesterday. And this one right here is November 11th. All right. So this is the beginning of my day. Let me go ahead and do a vertical line right here. Vertical line right here. So if I correlate the beginning, or at least, I mean, this is not the beginning of today, but it includes the data today. And if you think about the beginning of the day today, you see that there was an up or a gap up from yesterday's activity. And just keep in mind that this column of X's is probably getting some data from yesterday as well. So the fact that you have a date of the 11th doesn't mean that this column started building on the 11th. It could bring some excess from the prior day. It doesn't look at time. It doesn't look at sessions. And that's why we started off with the column of X's. But what happens after that? We have 4 O's, 3 X's, 4 O's, 4 X's, 4 O's, 3 X's. The price seems to be switching back and forth between, going up and going down. And this is precisely what we see here in today's activity. Although there's a lot more noise on this left chart, For example, if we look at the candles, some candles are red, some candles are green, some of them are all over the place. So it's not a clean picture of where the price is headed, as opposed to the point and figure that we have very clear display of where the prices are going. Now, the point and figure chart makes it very simple for you to identify support and resistance levels. Do you see where the price started going down here on this column of O's, and it started going up again, and it stopped right here? Then it went down again. The column of X's here, it started going up again, and it actually ended up at the exact same point. So I can draw a horizontal line right here at this level, and that's exactly what that would be considered, or that's my interpretation of what it would be a resistance level. The price hasn't gone any higher than that level, but it's a clean level, 465. If I look over here on the left-hand side, and I were trying to see where the price had hit that, 465 is right here. So let me draw the horizontal line. Let me turn snap mode off. So drawing horizontal line, if I draw it right here at 465, there it is. You can see that we have some wicks and part of some candles bodies outside of that line. So those are the types of distractions that are removed by looking at a point and figure. Maybe those prices are important. I'm not discounting the fact that these candles went above the 465 line. But take a look at these three candles that kind of try to push the prices up. And we have these long wicks on the upper side of those candles, meaning that there was some price rejection. Sellers came into the game and they drove the price down. Point and figure makes it very clear. I can do the same thing here on the bottom side. I can go here to the drawing, click on horizontal line, and draw a horizontal line right here. It touches that bottom twice. And that level is 464, exactly 464. I usually use a snap mode because I'd like to my lines to go right on top of that end. If I were to draw that line over here on this left chart, that could be 463. It could be right here at 463.91. So a lot of this information makes it sometimes harder for you to pinpoint support and resistance levels. That's one idea only. I know this can be taken in so many different directions and so many different interpretations, but take a look at everything that happened today is condensed in a group of 6 different columns, because we told the chart, I'm looking for movements of 25 cents. And if the chart doesn't move 25 cents, I'm not interested. So that's exactly what the point, what any price-based chart is doing, is just ignoring any price movement that does not need the number that you are specifying. All right. So let's go ahead and take a look at some other price charts. I wanted to talk a little bit more extensively on this first one because I want to make sure that it is understood the concept of removing noise and making the chart much simpler when it comes to price movement. Because from this point on, every other chart type is just a different display, but it's the same concept of removing noise and providing you a simpler view of ups and downs. So Joe is asking, but how can you trade early in the day before the X's and the O's have been established? Remember that this is a running chart. There's no division between sessions like you do on a 5 minute. So when I was talking about this upward column, this is a column that probably includes data from yesterday or the prior trading session, but it still is a chart that updates in real time. Do you guys see the little arrows that are on the right-hand side? There's a green arrow that points to the current trading price, 464.55. So even if you were at the opening of the session, you would see this green arrow letting you know where the current price is, even pre-market. So, but it could still be building the column from yesterday or the column from the day before yesterday, because this is not based on time. This is based on price movement and where it's headed. The same applies, or you also see a second line, which is more like a red little dash over here on the right of the last column. That red dash is your reversal amount. So the price has to drop to that level in order to satisfy the reversal amount. We're still on a column of X's. That's what the current column is. So the price is tending to go up. Now, we see that on the current candle. The prior 5-minute candle, the prices were going down. So I'm pretty sure that that green arrow was getting closer to the reversal amount, but it seems like it reversed and it started going up again. So this kind of this little drawdown, this little reversal on the price, these 4 red candles are not reflected on a column because it's not significant. If you take a look at the prices here, 464.80 and 464.40, well, this is 40 cents. It's about 40 cents, right? A 40-cent drop. But what did we say that our reversal was? We are looking for a 75-cent reversal. So even though it did drop 40 cents, not quite enough for me to change my column of X's to a column of O's. It has to meet that reversal amount. So there's a lot of information going on, and I'm going to leave the interpretation to you because there's many different ways to interpret this. I do want you to analyze historical columns, O's and X's, and see where you find these support and resistance levels. Does it include after hours? If you set it to include them, yes. If you go here to sessions and you include them, of course, it's going to include the overnight, the pre and the post market. Let's go back here to my PowerPoint. We have a lot of content to cover. So I'm going to breeze through some of the content here because, as I said before, the purpose of these charts is to do one main goal: remove noise, consolidate the chart, simplify the view. Let's take a look at Renko. When the market moves in the same direction of the prior Renko brick, the specified brick size, specified by brick by the specified brick size, that's what it says here. So the Renko has to move by the specified brick size. A new brick will be added in the same direction as the prior brick. When the market moves in the opposite direction of the prior brick by twice the specified brick size, a new Renko brick will be added in the opposite direction of the prior brick. I usually don't like reading this PowerPoint because it's kind of confusing. I want to encourage everyone to pull up your TradeStation, pull up a chart and try to understand where the price is headed. A lot of times reading how the price is moving and what determines the moves ups and downs is kind of confusing. If there's no significant change in price, example, the price oscillates within the range of the last brick, no new brick will be added. Let's go to TradeStation and take a look at a Renko chart. I'm going to leave this chart open. I'm going to use the same chart here. I'm going to go to time frame, customize, and we're going to do Renko. There's different, Renko styles. We have a classic, we have a mean, and we have a custom. Let me just explain the classic, and we'll take it from there. Notice that there's a brick size of 50 cents as the default, but you have to specify the brick size. The brick size, just as in the point and figure, is what you consider to be a significant price movement. So again, we go back to the idea of using average true range to see how the price is moving so that we can enter a number that is appropriate for Spider. Every instrument that you build a price-based chart off is going to have a different, market movement. It's going to have a different price profile. So you have to choose something that goes with the symbol that you're trading. For Spider, I look at average true range. Notice that my ATR is kind of getting down. It's going down. Now it's 17 cents on a 5-minute chart because the candles are getting smaller and smaller. So let's say, for example, that I still want to use my 25 cents Renko. Okay, this is what the chart looks like. Do you see some similarities between this and what we had seen on the point and figure? I do. You see the horizontal line right here touching those 2 boxes, and you see this horizontal line here touching 3 boxes. But the way that the chart builds is going to be different. Let's go ahead and remove some of these lines because this is Renko. Take a look at what's happening right here on the front, because looking at the real-time building of the candle is what's going to tell you or give you clarity of what is happening. Do you guys notice that this box is kind of a brighter or kind of a shaded gray of green, different shade? It's because it's not a fixed box yet. And when I say fixed, I'm talking about the number that we specified, the 25 cents. The top of this brick right here, let me look at the highs, 464.57. So the current price has to reach 25 cents higher than this. So exactly 464.81 in order for the box to be fixed. See, right now the box is getting smaller, it's getting bigger, and it's only when it reaches the box size that we specify of 25 cents that it'll be static, it'll be fixed, it won't change anymore. And once it's fixed, it'll go on to the next one. Now, I want you guys to notice that if the box is fixed, let's take a look at the one prior to that. Once the box is fixed, like the one prior to the one that is fixing right now, the price can go up and you'll see this kind of shaded or kind of a light green box. It can go down. If it goes lower than this fixed box, it'll look like a little dash, right against the right side of that brick. And then if it starts going down lower than the low of that box, then you'll see the opposite effect. Instead of seeing like a light shade of green up here, you'll see a light shade of red down here. And it's going to continue to be light red until the actual box is hit. Does that make sense? So this is Renko. Renko is very simple. Based on the brick size that you specify, we are just going to be stacking boxes up and down based on where the price is going. Nothing more than that. It's not complicated, but it's interesting that it's not time-based. The times that you see down here don't really correlate to a time-based chart, although you have an approximation. If you look at the beginning of today, is right over here, 11.11, and that's where the prices started moving up and down. But you can see clear lines forming at the top and at the bottom once you remove a lot of the noise from the chart. Okay? Understood. I don't see any more questions. Let's go over here to the next one. And as I said at the beginning, we talked about point and figure. Everything else, every other price-based chart is going to be doing the same thing. It's just the way that the bars are built that changes. But what we're looking for is price movement and for the chart to meet what you specify to be a significant price movement. Okay, let's go here to my Kagi. Renko, I do like Renko too. Somebody says here, I like it a lot already. Renko, I've done strategies. One of the things, and this is something really fascinating, because once you learn how to build a price-based chart, you can start doing technical analysis and strategy development on these types of charts as well. I've worked on strategies on these Renko charts based on how the bricks are being built, and they're fascinating. But you do need to understand price behavior and what's happening on the real-time bar, because that's what's going to determine, the boxes. Nothing is fixed until your target is hit. Like when we looked at Renko over here and we're looking at this, see, I was referring to the dash on the right-hand side. You see, we're getting lower and lower. Now that is because we're next to a box. This type of chart doesn't draw boxes next to each other. It waits until the price is either higher or lower than the previous box. So now we see that dash. And I just lost my train of thought. Well, the fact that you can design strategies and look at technical indicators under this context makes it very, very useful. So Kagi. Let's talk about Kagi. Kagi charts display a series of connecting vertical lines whose thickness and direction are dependent on price direction. When the market moves in the same direction as a prior Kagi line, the line will be extended. And when the market moves in the opposite direction by at least a reversal amount, a new Kagi line in the opposite direction will be displayed. The color and width of the Kagi line changes when the Kagi line breaks a prior high or prior low. Very interesting type of chart. Let's go back here to TradeStation and take a look at it. Let me resize this. I don't think we need that average true range anymore because we already know that Spider moves about 1/4 of a point on a 5-minute chart. Let's go here to customize, and I'm going to choose Kagi. Kagi introduces the reversal, and we have a fixed price and a percentage. Now, there's no box size here. The only thing that the Kagi line asks for you to enter is to enter a reversal amount. That's it. Now, remember, my reversal is going to be 75 cents. Let's go ahead and take a look at the Kagi line. Everybody sees my Kagi? You see how the line, I can already tell from the very end of this chart I'm focusing here on the very current line. I see that the line is extending up. If you look at this line as a snake, and this would be the head of the snake, is actually going up, right? So don't get confused by the color here yet, but the direction of the line is going up. So the prices are going up. The current price is 464. So it's not exactly, let me make this bigger so you can see. So it's not exactly at the high of that line. But if the line or if the price were to continue to go higher than the highest point of that line, the line will continue to extend. It's like it just continues to snake. But since the price started going down from that highest peak, then you get that little arrow letting you know where the price is. Now, the second dash here is your reversal amount. We did say that we had a 75-cent reversal. If it hits that reversal, what will happen to my line? It'll reverse direction. Now it's not going to be going up. It's going to be going down. Very simple concept, going up or down based on the reversal amount. Now the color is based on where the price is in relationship to the previous high or the previous low. Do you see where this upward line changed from red to green? Do you know why it changed to green? Because it crossed the higher high. So whenever the Kagi line crosses a prior high or a prior low, it'll change color. And as the line maintains its color, for example, in this area, we had a upward, downward line. As it maintains its color, it's because it hasn't crossed below a prior low. It's not until this direction that it crossed the prior low and it changed the color. So the color only changes when it crosses a prior high or a prior low, depending on the color that you're on, okay? So let's go ahead and take a look at another one. Range. I'm going to talk briefly about the next three, which is range, momentum, and Kase. Why am I talking about them three altogether? Because they are pretty much the same. I'll highlight the differences and what they're looking for, but they're the same type of price charts. First of all, the range. Everybody here knows what range is, right? We're running out of time, but we're good. Range is how tall the bar is from high to low, right? That's range. What we are telling the chart to do is to target a range. So when you specify a range of $1, for example, the difference between the high and the low has to be exactly $1. And it's not until there's enough price movement to make the high and the low $1 that the bar will continue to build until it does. Okay, that's key to this types of charts. Let's go ahead and take a look here at trades. And that's what it says here on the PowerPoint. The size of range bars will always be the range size set by the user and will never be anything smaller or larger unless it is the current bar that is building. Yeah, the current bar, remember that it's real time. So it's going to be definitely smaller than your range. But as soon as it reaches your range, it'll go on to the next one. Okay, the open of each range bar is always equal to the close of the previous range bar. So as soon as you hit that range, then it's going to open up the next one. The closing price of every range bar is always going to be, well, it's not always going to be at the top. It depends on where the bar closes. There are no gaps displayed on a range bar. That's something that you have to remember. So let's go ahead and take a look here on a chart so that it makes more sense. I'm going to come over here, go to time frame, go to customize. Do that again. Time frame customize. I'm going to go here to range. Take a look at the top. All that it's asking for you to enter is the amount that you think it's a significant range for Spider. I know that Spider moves about a quarter of a point every 5 minutes, an average, based on the average true range. So maybe if I'm looking at intraday, maybe I'm shooting for a $1 target. You know, let's see if that gives us a full chart. I'm going to go for a $1. I'm going to click OK. And this is what I see. Let's take a look at the chart. I want you guys to take a look at the time scale at the bottom. You can see where today's trading activity begins right here, beginning of the 11th. Yeah, this bar is the 10th, so this is the beginning of the day. Although this is not time-based, I always look at the time scale just to have a comparison between what would be a 5-minute and what I'm building right now, so that I can see what effect it has on the number of bars that are seen for today. I only have a total of 7 bars for today on a $1 range bar. Every bar or every candle that you see here is going to be exactly $1. You want to check? Well, let's check that very first bar for today. And I want you guys to take a look at the high and the low right there in that data tips window. The low is 463.55. The high is 464.51. Did I say the? Let me repeat that because I think I said my numbers wrong. The low is 463.51 and the high is 464.51, meaning that we have exactly $1 between the high and the low, except for the most current bar. If you look at the current bar, the high is 464. I need to put my glasses on. Okay, so the high is 464.84 and the low is 464.40. So we have 44 cents. 44 cents is the range of that bar. So what's going to happen? Well, that bar is going to continue to build. What happens if the price stays at 464.43 for the rest of the day? Well, I won't get a new candle. The candle has to reach that $1 range that we specified. And what happens if tomorrow the market opens and the price doesn't go anywhere? It stays at 464.30 or 64.38, which is the current price. Well, I'll still be building that same bar. This bar builds up until you reach that target. Otherwise, the chart will not go anywhere. The problem, I won't consider it a problem. Let me go here. Let me load more data here. Let me load 30 days of data. $30 days. That's loading data. I think I have another chart here open. I do. I left it open. So let me go 30 days here. I'm going to do a 60-minute. Let me remove some of the lines that I have here. Okay. Because what I want to take a look at is this? I'm still waiting for data. I shouldn't have gone 30 days on this, but it's okay. Let's go ahead and take a look at range and how far back it goes. I mean, we have years of historical data, so you can load all these charts. And for a moment, I just forgot what I was going to tell you guys. But oh, I was looking for a gap. Yeah, let me look for a gap here. All right, we have some big gaps here. There's a big gap right here on October 14th. There's a gap up. And I want to see where it lands right here on my range bar, but it's taking a long time to load. Let's take a look at some of the questions here while I'm waiting for this to load. Can the bars be solid? I think you're talking about the Renko. Renko, it's a very specific style, so it's kind of an outline more than a solid brick. Unless you go into the other calculation styles, we looked at the classic. I think if you go to the other calculations, you'll have a different style. I think you'll see some solids there. Let's see. Lauren says, what is the difference then Renko, please? Well, as I said before, a lot of these price-based charts are going to be somewhat the same. They're looking for either a specific brick size, or like in this example, I'm looking for a specific range, and the range and the brick size are things that are user defined. So differences they're not that much different. It's just the way that the bars are being built. On a Renko, we're kind of looking at stacking boxes based on the brick size that we specify. Interesting concept. But here, we're not really stacking boxes. We're just trying to reach that range bar to bar. Let me look at history. Now, I want you to take a look at this because this is key in understanding range, momentum, and case. Do you see right here, I have a big gap from October 13th to October 14th. There was a big gap. If I look at October 13th here to October 14th, I don't see the gap. In fact, I see some weird looking bars. I see this upswing that is probably represented here by the gap, but I see that the range chart on the right-hand side is filling the gap. That is a characteristic of the range bar. Even though there wasn't any trading activity inside the gap, it's taken into account the price movement represented by the gap. So it's creating what's called virtual bars, because it assumes that even though there's no volume, no trading activity, the price had to go through there in order to reach the level that it is right now. So it creates what we call synthetic bars, or bars that they're not really backed up by volume. There's no trading activity. So range and momentum are two types of charts that are always gonna fill in the gap with virtual or synthetic candles, just to show you the price movement, because the price did move. When you have a gap up, that's a price movement, right? So if these are price-based charts, that gets represented as a candle, even though there's no trading activity there. The difference between, let me just go back here to my PowerPoint. The difference between range and momentum, in fact, the only difference is that one closes or starts. Let me rephrase that. The range bar, the one we looked at previously, will start the new candle as soon as it meets the range. So as soon as we, in the example of Spider, we had a range of $1. As soon as it meets that $1 range, it's going to go on and open up the following bar. So the closing price and the opening bar, and the closing price and the opening price of one bar to the next is going to be exactly the same. Do we want to confirm? For sure. Yeah, let's go here to range. Let's look at the bar prior to the one we're building. So the closing price here is $464.84. The open of the next one is $464.84. Exactly the same price, because it doesn't wait. It meets the range, it goes on to the next one. Momentum, the name implies that it has to have some momentum, meaning that it has to exceed the range by 1, which means that if Spider meets the range of $1 on the current bar but doesn't exceed it, it may just continue to trade within that bar until it exceeds that additional tick that it'll take it to the following bar. That's the only difference. One switches automatically once the range is met. Momentum waits for that extra tick that exceeds the range to go to the next bar. So understand that, because one will be a little bit delayed when it comes to trading activity, which may not be a big deal for Spider since Spider moves a lot. But for slow moving markets, if it hits the range and it doesn't exceed it, momentum will stay with that bar until it is exceeded. All right, let's go ahead and take a look at the next one. All right, let me go here to my PowerPoint. Kase. Kase is the one that is also very similar. Running out of time, but Kase is a type of bars. In fact, they were introduced by a lady by the name of Cynthia Kase, and hence the name Kase chart. She said, I don't like how my range chart is filling up the gap. I don't like this idea of the chart creating synthetic bars, creating candlesticks where there's no trading activity. And maybe you feel the same way. You're looking at these charts and saying, well, I really don't like, how it's filling the gap. I like to see the gaps on the chart because they are significant events. And that's what was her style as well. But it's the same type of range and momentum bars where you're looking for a target. Let me go back there to TradeStation. Let me switch this to 5 days. I don't want this to take a long time to calculate. I'm going to go to time frame, customize. I'm going to select Kase. The target is $1, and I'm going to click OK. But I do need it to go 30 days back because I want to take a look at that gap and see how it is different than range and momentum. Range and momentum creates those synthetic bars. Kase does not. It only uses real trading activity. So if I go back to that same area of October 13th, you see how the gap is visible. All right, so pretty cool, huh? Another thing that Kase does is that it uses real trades. For example, on the current bar, if you have one tick that is probably a few ticks higher or lower than the current price, and it meets the range, range and momentum will kind of split that trade and make every single bar exactly, your target, which is $1. In Kase, you're going to have some bars that are sometimes more than $1 or a little bit less than $1 because the price doesn't move so precisely. Sometimes, you skip a penny, you skip a few pennies if you're trading stocks, and you have to account for that. Range and momentum, they'll just slice the bar and give you perfect ranges. Kase only uses real trades. So if there is a trade that exceeds the range by more than a penny or so, it'll show it. Let's look at some examples here. Let me see. This is the same. So for the most part, especially for Spider, a lot of these, okay, take a look at this one. I'm not sure if you guys see the prices of this one, but the high is 464.28 and the low is 463.51. So we have a difference of 50, 60, 70, 77 cents. So right here. So this candlestick is only 77 cents instead of the full $1. Why? Because there's probably one trade that threw off the range, and instead of including that trade in that candle, it actually moved it over to the next one. In a range or momentum, that trade would have been split up, and this bar would have been exactly $1, and the next one would be exactly $1, okay? So let's go here to the next one. Up and down volume does not work in Renko bars. Probably, there's a lot of chart analysis indicators and studies that are probably not going to work on these price-based charts. So it's a trial and error. Just let us know if you find something that should work and it doesn't. All right. If you have to pick one, which is your favorite? That's a hard question because they're all good. I've done some work on Renko. I've done some work on point and figure, which is the classic, but they're all really interesting. Usually I don't use momentum and range that much. If I were to use a range bar, I would probably use Kase because I like the idea of showing gaps. I like the idea of sticking to real trades rather than creating these synthetic bars. All right, let's go here to the next, last one, line break. I know that we're running a little bit over. It's already 63 minutes of presentation. Hopefully, I'll be able to slice off the recording and make it a little bit more watchable. But let's go with line break. The line break chart is made up of a series of vertical blocks called lines. Line break charts are most commonly set to 3 and are known as 3-line break charts. And a break of the lowest low of the last 3 up lines will generate a down line. And a break of the highest high of the last 3 down lines will generate an up line. What in the world are we trying to say here in this PowerPoint? and do this exercise, read this. Of course, it's not going to make sense. Go back to the chart, try to understand where the price, I've had to sit there and watch a chart and see how it's building to be able to understand what's happening. Once you understand the chart, you come here and you say, oh, now it makes sense, So here, what we're looking at, let's go here to TradeStation and turn this into a line break chart. So time frame, customize. This is the line break. In a line break, you have to specify how many lines to break. The name or the word line here refers to the actual box or the actual bar. Let's call it that way. Okay. So 3 line breaks means that I have to break the prior 3 lines or the prior 3 boxes. Let's take a look. I'm going to click OK. All right. The current bar is going to give you a little bit more clarity. Do you guys see where the price is? It's at 464.20. And as it goes down, you get this lighter shade of gray, meaning that it's not a fixed box yet, because what does it need to do? Well, the price is going down. In order for this to be a fixed red, it has to be or come down lower than the prior 3. 1, 2, and 3. So the price has to go below this low in order for this to be a fixed red. Interesting, huh? If the price starts going up, then see how it's doing it right now? It adds more boxes to the top. This is the 1 tick chart. So every time that it ticks 1 up, it adds a little box, and then it starts keeping track of the prior 3. Take a look at that red one here. Since it went down and it went lower than the prior 3, then now it's fixed. It had a little bit of a challenge to come down here, but once it had new lines or new boxes, it was easy to break those prior 3. And it's going to continue to do that. You see right here, it breaks those prior 3. Let's wait until it breaks that prior low. 1, 2, 3. It has to go lower than this one to be fixed. And if it doesn't do it, if it goes up, it'll just continue to add green ones. But that's the whole way that this chart builds. It just looks at the prior 3, if you set it to 3, of course, and it'll wait for the price to break those prior 3. If you want to make this a little bit more restrictive, of course, you come here and you say, well, I want to do a 10 line break, which is more restrictive. Take a look at what's going on here. Now it's looking at the prior 10 boxes. And look at this big light shaded of red. It's going to wait, well, 1, 2, well, this is odd. Now, because it's looking at the 10. 1, 2, 3, 4, 5, 6, 7, 8. And 10. So it has to come lower than this low right here. Challenging? Yes. Impossible? No. But you can see that by increasing the number of lines, of course, it's going back more in history, and it has to cross those prior lows or highs. Okay? Okay. Can't see the difference between Kase and momentum. One of the major differences, Don, is that it doesn't create synthetic bars. So locate a gap in history, like on Spider or any other instrument, and then bring up a case bar and look at the gap. You're going to see the gap and compare that to a momentum where the gap is going to be filled with synthetic candles. That's one of the bigger differences, but they both are looking at a target range. So they are going to be very similar in the way that they're, building the bars. Can we customize the value instead of one tick? Yes, this line break is responsive to one tick. But if you go in here, you can use minute data if you want to. A lot of times, we may want to build these charts on a slower time frame, and you can do that by selecting a different time frame. Okay, that's something that it's up to you. A lot of the price-based charts, though, that's the way that they respond. They respond to one tick chart. You want to see what the price is happening at the moment as it happens. But if you want to look at historical data, and this is especially true if you are looking at more than 6 months, you're probably going to want to do a higher interval. Okay? When you set up any of these price-based charts incorrectly, and I say incorrectly, meaning that you put in a target or you put in a box size or you put in something in the settings, you put in something that is not appropriate for the symbol that you're watching, you're probably going to get an empty window. For example, I'll show you an example here. Let me see. Let me get rid of this. Let me go to a different workspace. Let me open up a chart. So let me go here to AT&T. Okay, let me see if I go here, double click, and I go to, let's say, a Renko, and I'm looking for a box size of $2. When it loads the data, take a look at what happens to my chart. All I have is one big box right here on the left side of the chart. So this is maybe happening to you. It's because I just picked 2 as the box size for AT&T. AT&T is trading at $24. And since this is a chart, let me see how far back it's going. It's only going back 2 days. So how many times has AT&T moved $2 in the past 2 days? So always think about how the security is moving and if the numbers that we're supplying in the brick size and the reversal are appropriate for the symbol that we are charting, okay? Perfect. Excellent. So keep that in mind. I can't really stay much longer, so I want to appreciate your time. Thank you for joining me today. The presentation is recorded, so you'll have an opportunity to watch the archive. I wanted to give you guys a lot of information about how these charts work and all the technicalities and how you can set them up. Hopefully you walk away with something useful and something that you can practice on your own TradeStation platforms. I want to say thank you again. I hope to see you in a future event. Please check out the content inside of the Getting Started and the TradeStation Masterclass. That's 2 offerings by TradeStation that are on youcantrade.com. And I'm doing classes there every single day. So I'm looking forward to seeing you. Okay. Thank you guys. Have a wonderful afternoon and good luck in your trading. Goodbye, everyone.